Okay, so hello guys. Welcome to the January session for 2026 advanced class. So first of all, the strategy that I trade all revolves around four key concepts. We have market structure, liquidity, point of interest, directional bias. These four concepts makes up the strategies that I trade. So we're going to take it slowly. And one thing I'll tell you guys is learn at the same pace that I'm teaching. There are some concepts that you may have been used to, which is not included in the strategy that I trade. So because it's not included, I don't expect people to start asking me questions about those concepts. For example, I don't use fair value gaps. I don't use there are some things I don't use. So when someone starts telling you, "Oh, what about fair value gaps?" It's not part of the strategy that I trade. Do you get? So just learn at the same pace as I teach everything that you need for this particular strategy to work for you. I'm going to go through it and I'm going to teach it well. So just learn at the same pace that I teach. Most people after the first session they will start analyzing trades and start sending to you to tell them whether it's correct or not so they can take it. Meanwhile, we've not even gotten to the second session that explains the second POI that we use, or we've not even talked about different types of liquidity that can make sure you're not taking trades in a liquidity zone. We've not talked about directional bias, all those things. So just be calm to learn at the same pace as you're being taught. Do you guys understand? Can you hear me? Please, there's someone that his camera is on. You know your camera is on, please. Can you turn it off, please? So if you know you have your camera on, please turn it off. Okay. Okay. Okay, so we're going to, like I said, we're dealing with market structure, liquidity, points of interest, directional bias. So we're going to start with market structure first. Then we'll talk about liquidity. We'll introduce liquidity. We'll talk about one of the POIs that we'll make use of in this class. Then the next class talk about the other POI that we'll make use of and talk about the rules of picking a proper point of interest. We'll talk about different types of liquidity and how we take our profits using those types of liquidity. Then finally, we'll talk about directional bias. So each class that we have, the question session for the class will be in the next class. So as we have this class now, the question session will be in the next class once we send the recording for the class. So once you watch the recordings and all, the class, that particular class and the next class that we'll have the question session for it. You can ask questions for when you're confused, for when you watch the recordings and map out the questions that you have. But if we have this class, at the end of the class, I will send the recording to the group chat. Then you go through the recording, you learn and you map out the questions you have. Then the next class that we'll have after that class, both the questions for that particular class and this previous one, you just bring out your questions for when you're having difficulties in. And mind you, guys, I said this is not a beginner's class as well; it's an advanced class. So let's um let's get started. So hope you guys can hear me well. Am I free to start? Okay, good. So first of all, we're going to talk about market structure. So what is market structure? Market structure is basically the current flow of the market, the current pattern or the flow that price uses to approach one level in the market or another. If price should move from this zone to this zone, the flow or the pattern in which markets used to approach this level to this level is what market structure is. Market moving from this level to this zone, the flow that price used to approach from that level to this level is what market structure is. So market structure is basically the current flow of the market, the pattern in which market used to approach one level in price or another. That is the definition of market structure. Now, there are three distinctive patterns in which market makes its movements. If you open up your charts, you always see price moving either this way, that way, or that way. It's always fixed. There's no way you open up your charts and market is not giving you either one of these moves. So the first one is categorized under trending markets, and the second one is categorized under ranging markets. So the first two under trending markets, you have the uptrend, then the downtrend. So the uptrend basically being when market is giving you a series of higher highs and higher lows. So if market is giving you a series of higher highs and higher lows, higher high and higher low. So each high that price will present presents will be higher than the previous one. So and each low will be higher than the previous one as well. So notice how this high and this high are not on the same level. This current one is higher than the previous one. And this low and this low is not also on the same level. Each low is low higher than the previous one. So this high and then this high won't also be on the same level as well. And the low here will also be higher than the previous one. This is what makes up an uptrend. So it's categorized under trending markets. It's one of the examples of trending markets that we have. One of the trending patterns we have. The first one is the uptrend. Then the second one is called what? A downtrend. That is when price is giving you a series of lower highs and lower lows, lower high and lower low, lower high and lower low, lower high and lower low. So notice each high will be lower than the previous one. Each next high that comes out will be lower than the previous one, and each low that comes out will take out the previous low. That is what makes up a, a valid downtrend. And for the uptrend, each high that comes out will supersede the previous one, and each low that comes out will also be higher than the previous one. That is what makes up a valid uptrend. So under the trending section of market structure, we have the uptrend and the downtrend. Then under the ranging side, we have what you call a consolidation or a ranging market. It's basically when price is not trending up and is not trending down, it's basically ranging, moving from your support level to your resistance level to support level to resistance to support. So this is what you call a ranging market. So if you check for the uptrend, if you use a line to draw out, you can draw that market is trending up because of how slanted the line will be, slanted to the upside. If you draw the downtrend, you can also tell that it's trending down because of how slanted the line will be to the downside. But if you try to do that for this ranging markets, you can't really tell whether market is trending up or is trending down. Instead, what you will see is price moving in a horizontal pattern. Hope you guys are following me up. Okay, so these are the three ways or the three patterns that markets makes its movement with the uptrend, the downtrend, and the ranging market. So there's no way you open up your charts that you wouldn't see market either trending to the upside, trending to the downside, or ranging. It's always fixed. Either price is what? Trending up, trending down, or ranging, or it's trending down, or it's trending up. So it's always fixed with these three movement patterns. It's fixed. So these are the three basic introductions to market structure, the three basic ways that price makes its movements. That's that's just the basic introduction to market structure. But when it comes to what we actually pay attention to, when so wait, an example of the uptrend is this, downtrend is uptrend is this, downtrend is this. So it's very clear on the chart. The ranging market is something like this because you can't really tell whether it's moving up or down, but you can see it moving in a horizontal pattern. So that is just the basic introduction to market structure. What do we actually pay attention to when we're dealing with the structure part of our strategy? There are two concepts that we pay attention to when it comes to dealing with the structure part of this strategy. There are two concepts that we pay attention to. The first one is the concept of hang on, hang on guys. Alright, so like I said, under market structure, there are two concepts that we pay attention to when it comes to trading the structure part of our strategy. We already understand the patterns that price makes its movement with. That is just the basic one. But with these patterns, what do we actually expect from these patterns? Yes, we understand that when we're dealing with when we open up our charts, our focus should be whether to identify whether price is what's trending to the upside or to the downside or is ranging. We understand that. But once we spot these kind of things, what do we actually expect from these structures? There are two things we expect from it. The first one is what the concept of reversal, and the second one is the concept of continuations. What do I mean by this? So I said the first one is the concept of reversals, second one is the concept of continuations. What I mean by this is if you have markets trending to the upside, there are two possible scenarios that price can give you. Now, the first scenario is price can continue pushing back up. The second one, while at this level, price can start selling down. Same thing here. You have this clear downtrend. While at this level, there are only two possible scenarios here. Price can start pushing up or price can continue selling down. So if market is at this level and it continues to moving in the upside, that is the concept of continuation. But at this level, if price fails to still maintain the uptrend and starts selling to the downside, that is the concept of reversal. Same thing for this downtrend. At this level, if price continues selling to the downside, that is the concept of continuation. But if at this level, price starts buying to the upside and ends the downtrend, that is the concept of reversal. So that is why I said when it comes to market structure, yes, we have three distinct patterns, but what we actually expect from these patterns is now where the concept of reversals, concept of continuations comes in play. Now, the reversal concept can be applied to only trending markets, but the continuation concept can be applied to both trending markets and ranging markets. Because for this ranging market, the only thing you can possibly actually trade here is if markets, for example, as is ranging, it breaks out of one. So let's say it breaks out of this range, then you can start what trading in that new direction that the breakouts occur in, which you guys understand the concept of break and retest is something like this. Or it broke out from this range, then you start trading in this direction. So this is what the concept of continuation, basically trading in the current direction of the movement of the market. So the trending market, you can only use reversal concepts on, and you can also use continuation concept there, but you cannot apply reversal concepts to ranging markets. Hope you guys are following me up. Somebody shout power. All right, let's continue. So, like I was saying, we expect two things from structure. Once you've already identified the structure, to identify the structure part of your strategy, you need to know whether price is on the verge of giving you a reversal or whether price is on the verge of giving you a continuation. That would better allow you know whether you are looking for buys, whether you are looking for sales, or what to do next on the chart. So, what do we actually trade? How do we trade the concept of reversals and how do we trade the concept of continuations? Now, I would say this, we trade continuations more times than we trade reversals. Reversals are traded fewer times than we trade continuations. What do I mean by this? There are two possible scenarios where you can trade reversal concepts. This one is at the start of a new trend, and the second one is at the end of a current trend. For example, let's assume there are 2 points in price where market goes to. So let's assume price goes from here to this other side, here to this side, and here to this side. Now, when reversal concepts can come in play is when market gets to this level. Before it starts pushing to the other side, you will probably get a reversal concept here, which is telling you that price is about to change direction to the opposite side. Now, once market starts moving in this direction, if you're looking for more entries for the current direction of the market, you will be trading continuations. Let me make it something clear. Say at this level, before price started pushing to the upside, you will get a reversal concept somewhere around here. Now, after the reversal concept, if you're looking for more entries now to take the current direction of the market, you will now be trading continuations. You will no longer be looking for reversals. You'll most likely be trading continuations. The reversals will come fewer times than you trade continuations, but continuations, you trade it much more than you trade reversal concepts. Just like this, market was bearish, and you expect price to start buying from this level. When market was bearish, if you're looking for more sales to take for that bearish move, you'll be trading continuations as well, another continuation entry. Then when price gets to this level where you expect the buyer to come in, before the buy will happen, you will get a reversal concept here. Now, once you've gotten that reversal concept and market is now currently bullish, if you're looking for more buy entries, you'll be trading continuations, continuations, continuations. So check, we've only traded reversal here, but we've traded continuations multiple times here and multiple times here as well. The only time you can look for probably another reversal concept is what? When price wants to change direction and stop buying and wants to start selling, you get another reversal concept here. Once you've gotten that reversal, so you check, we traded reversal continuations like 2 or 3 times here, reversal once, continuations like 3 times, reversal once. Then you start trading continuations again for the new downtrend of the market. Hope you guys are following on what I'm saying. Okay, okay, okay. Mhm. So what I'm trying to say is that the reversal concept we trade it few times, but the continuation concept we trade more times. That's what we call, well, in directional bias classes, you understand why we trade reversals fewer times. And also, we don't just expect reversal from anywhere. There are zones in the market where we actually expect these reversals to come in. Now, I want to give you guys a brief on directional bias. What I mean, like when I trade directional bias, I focus on trading directional bias in a trend-like pattern. What I mean by in a trend-like manner is I want to see price on an uptrend on the higher time frame for me to be overall bullish on the like on the lower time frames. Then I want to see market on a downtrend for a on the daily time frame as well for me to be bearish on the lower time frames, something like that. So like I trade in line with the current direction of the market. Now we already understand that the uptrend is made up of higher highs and higher lows. So on the daily time frame, if market is on an uptrend that is bullish, you'll probably likely be seeing some of this. Now this is what the daily time frame. Now, since this is the daily time frame, you're not going to be trading on a daily time frame, but daily time frame is just to get directions, directional bias to know whether you're looking for overall buys or overall sells. So if market is giving you this on a daily time frame, it's very obvious to say that market is what? Bullish. Now, because market is bullish, and you understand how trends work. After every impulse move, there will be a correction. If impulse move is what this push to the upside, the correction is this sell that will trigger another zone where another push to the upside will come. So the impulse move is the buy, the correction move is sell. The impulse move is the buy, the correction move is what? The sell. If it's a downtrend, the impulse move is the sell, correction move is the buy.